Good day, everyone. In this session, we will explore the intersection of transfer pricing and indirect taxes with a particular focus on transfer pricing and value added tax, custom duties, and other related taxes. So, this is Module 15 transfer pricing and indirect taxes. As we've always defined, transfer pricing refers to the methods and regulations governing the pricing of goods, services, and intangibles exchanged between related parties. Now, the primary goal is to ensure that intercompany transactions are conducted at arm's length price, that is, the price that would have been set between unrelated parties in a comparable transaction. Why is this important for VAT and other indirect taxes? It is important because the taxable value for these taxes is derived from the transaction value. Any misalignment in the pricing of intercompany transactions can have a significant impact on indirect tax liabilities, leading to incorrect tax calculations, compliance risk, and potential severe penalties. So, we've looked at the overview. VAT and other indirect taxes like sales tax, goods and services, excise duties can be significantly affected by transfer pricing practices. Ensuring that intercompany transactions are correctly priced at arm's length is essential for accurate calculation of all these indirect taxes. So let's look at key consideration now. One is transaction value. Now, the value of goods or services exchanged between related parties serves as the base for VAT and other indirect taxes. So, if the transfer price is understated, it may reduce the VAT base, leading to underpayment of taxes. These, of course, attract attention from tax authorities. So let's give an example. Imagine that a product is priced at $1,000 for transfer pricing purposes, but when it comes to VAT reporting, it shows as $800. What it means is that there is a discrepancy of $200, which could raise a red flag for tax auditors or tax authorities, signaling potential undervaluation. Now, consistency with transfer pricing policy. This is another key consideration. Your transfer pricing policies must align with indirect tax regulations. Any deviation between the value used for transfer pricing purposes and the value reported for VAT could result in either underpayment or overpayment of taxes, or worse, a double taxation. Now, example is when we consider again this same product that is charged at $1,000 for transfer pricing purposes but value at $800 for VAT purposes. The inconsistency not only distorts your VAT obligations but may lead to a tax audit where authorities question the integrity of your transaction. Now, let's look at another key consideration, which is cross-border transactions. Cross-border transactions are particularly tricky because each country applies different VAT rates and has unique VAT regulations. So, align your transfer pricing policies with the VAT requirements of multiple jurisdictions is crucial to avoid discrepancies. If these are not managed properly, companies risk both tax inefficiencies and disputes. And the implication of this is that transfer pricing affects your businesses in several ways, particularly regarding indirect taxes. So let us look at how it affects it, the implications. Now, with respect to VAT liability, the transfer price determines the VAT base. Understating the price can lead to lower VAT liabilities, but remember, this also attracts scrutiny from tax authorities. So over time, consistent undervaluation could result in audits, fines, or even legal challenges. Now, the second thing to look at with respect to implication is the custom duty. Custom duties. Now, custom duties are another key area influenced by transfer pricing. Mispricing the value of imported goods can lead to underpayment of custom duties, which also affect the VAT payable on those goods. Customs valuation and VAT obligations are deeply interrelated in cross-border scenarios. So let's look at double taxation, where there is a misalignment between transfer pricing and VAT valuation. Both transfer pricing authorities and VAT authorities, both transfer pricing and VAT audit may assess the same transaction differently. What this is saying is that during an audit, there will be a misalignment between transfer pricing and VAT valuation. And this creates a situation where a single transaction could be taxed multiple times in different jurisdictions, leading to double taxation. So in a particular jurisdiction, they could be looking at it from a VAT valuation point of view, while in another jurisdiction, they will be looking at it from a transfer pricing or VAT valuation point of view. And then, this may assess the same transaction differently. So, and it could lead to double taxation. Now, let's look at compliance and documentation for indirect taxes. Now, to manage VAT and other indirect tax obligations effectively, compliance is very key. In this session, we will focus on the documentation needed to support your transfer pricing policies and ensure compliance with VAT regulations. Proper documentation is not just a formality, it is essential for proving that your intercompany transactions are priced correctly and that the proper taxes have been paid. So failure to do this could result to penalties. Now, the compliance requirement, let us discuss the specific documentation and compliance requirement for managing indirect tax in the context of transfer pricing. So let's say invoice and receipts. Every intercompany transactions must be documented with clear, detailed invoices that reflect the accurate value of goods or services. And these invoices should include the correct VAT amount, a description of the goods, services, and the parties involved. So this ensures transparency and helps resolve disputes during audits. Now, transfer pricing documentation. Your transfer pricing documentation must provide comprehensive evidence that the value of intercompany transactions align with the arm's length principle. This ensures that the value for VAT this also ensures that the value for VAT purposes is consistent with transfer pricing, because misalignment could result in discrepancies, attracting audits or penalties. Now, your VAT returns too. Your VAT returns must accurately reflect the transactions as per your transfer pricing policies. If the taxable value on your VAT returns is inconsistent with your transfer pricing documentation, this will raise a red flag to the tax authorities. Cross-border documentation is also another important thing. Cross-border transactions require additional documentation to comply with VAT regulations in multiple jurisdictions. This may include import, export documents, invoices, VAT declaration, and proof of services rendered. So, for best, let's look at the best practices now. For best practices, I haven't looked at cross-border documentation. Now, to ensure compliance, you need to follow the following best practices. One is consistency. Ensure alignment between transfer pricing documentation and VAT records. So, inconsistent records increase the risk of audits, penalties, and disputes with tax authorities. Now, you also need to conduct an internal health check or internal audit regularly to verify compliance with both VAT and transfer pricing regulations. You need to be proactive, and this proactive approach helps you identify and rectify issues before they escalate into legal dispute or even before the relevant tax authority come to your office for audit. Proactive communication. Don't wait for a tax audit to clarify complex transactions as well. You can engage with tax authorities ahead of time to discuss and explain your transfer pricing methodology. So transfer pricing methodology, you can discuss this by being proactive, by engaging the relevant tax authority. And transparency helps avoid disputes and reassures authorities that your company is very compliant. Now, having looked at best practices, let us look at some case studies. Now, case study 1 will be looking at managing VAT in cross-border transaction. And in this scenario, we'll be looking at ABC Limited, a multinational manufacturing company that sells products to subsidiaries in multiple countries. So ABC Limited uses the comparable uncontrolled price method to ensure arm's length price in these intercompany sales. Now, the implementation, they adopted or they used the COP method to determine the arm's length price for goods sold to a subsidiary. So the company ensures that the transfer prices align with VAT valuation to ensure accurate VAT reporting too. And then secondly, comprehensive documentation, including invoices and VAT returns, is maintained for all transactions. And as you can see, the outcome would be positive because ABC accurately calculates the reports. They accurately calculate and report VAT, reduce the risk of underpayment and non-compliance, and they've also detailed documentation that supports the companies during the audit and ensure compliance with both transfer pricing and VAT regulations. So there is a detailed documentation to support whatever they've done, at the point of reporting VAT and transfer pricing and their transfer pricing policies. So it is that would be a very positive outcome for ABC Limited. Now, for case study 2, addressing VAT discrepancies in intercompany services. So DEF, in this case, DEF Limited, a global service provider, charges management fees to its subsidiaries for shared services. However, VAT rates and regulations vary across jurisdictions, creating challenges in valuing intercompany services. Now, the challenge is that there is we have differences in VAT rates across jurisdictions. Differences in VAT rate across jurisdictions lead to discrepancies in VAT valuation for intercompany services. Now, the solution that DEF has adopted here is that they review and adjust their transfer pricing policies to align with the VAT regulations in each jurisdiction. So please let us know that they review and adjust their transfer pricing policies to align with the VAT regulation in each jurisdiction. Now, the company standardizes its documentation, ensuring that both invoices and transfer pricing records. The company standardizes its documentation, ensuring that both invoices and transfer pricing records reflect the same value. So the outcome will be the alignment of transfer pricing and VAT valuation reduces discrepancies and minimize the risk of double taxation. So this compliance improves through standardized documentation, reducing the likelihood of dispute is very, very good outcome for them. So the importance here is that you must ensure that your transfer pricing policies aligns with each jurisdiction's VAT regulations. It is very, very important. Now, on case study 3, indirect tax planning. Now, for case study 3, we are looking at indirect tax planning for digital services, where we use the GHI Digital Limited as a case study that provide digital services and licensing software to related entities across multiple countries. The company applies a royalty-based transfer pricing model, but different VAT rules for digital services in various jurisdictions to ensure that they comply. But the different VAT rules for digital services in various jurisdictions create a compliance challenge for them. Now, the challenge is that different VAT regulations for different VAT regulations for digital services complicate compliance. So the solution, or how they manage these challenges, is that they integrate. GHI Digital Limited integrates its VAT and transfer pricing policies, ensuring consistency in the valuation of royalties across jurisdictions. Now, the company implements automated system to manage intercompany transactions, reducing the risk of human error. So you can see that this integrated by integrating their VAT and transfer pricing policies and also ensuring they use an automated system to manage intercompany transaction and to reduce the risk of human error. And with this, they were able to optimize compliance by integrating VAT and transfer pricing policies. Now, the automated system also ensure accurate reporting and reduce the risk of audit and penalty. And just to conclude, this particular session actually focused on transfer pricing and indirect taxes with focus on VAT. Now, in conclusion, transfer pricing plays a critical role in determining VAT, custom duties, and other indirect taxes. As we have discussed today, ensuring consistency between transfer pricing policies and VAT valuations is very essential for accurate reporting and compliance. Now, through proactive compliance, regular internal audits, and consistent documentation, companies can mitigate risk, avoid penalties, and ensure they are fully prepared for tax audits. Our case studies have demonstrated how multinational companies successfully align their transfer pricing policies with VAT requirements through best practices, technology, and transparent communication with tax authorities. Thank you for your attention.